All right, in this explainer, we're putting a really fascinating company under the microscope. We're going to use the mental models of one of the world's greatest investors to see what we can find. So let's just get right to it. The big question guiding our entire investigation is this. Would the Oracle of Omaha, the man himself, Warren Buffett, actually invest in the dialysis giant DaVita? We're going to break this down piece by piece, just like he would. First up, let's build the case for DaVita. What is it about this company that makes it look like a classic Buffett-style investment? We'll start with its powerful competitive advantage, what he famously calls a moat. You see, DaVita operates what investors like to call a toll bridge business. Think about it. Dialysis is a simple, non-discretionary service that people's lives literally depend on. It's an oligopoly. There's basically just DaVita and one other major player. And the switching costs are high. You don't just decide to change your dialysis clinic on a whim like you change your coffee shop. Buffett would get this instantly. Now, let's talk about the price. The company is trading at less than 10 times its pre-tax earnings, which is a classic Buffett bargain indicator. Basically, this price tells you the market thinks the company has almost zero growth ahead of it. And that is exactly the kind of overlooked opportunity he loves to find. But this is the number that would really make him sit up and pay attention. This one figure gets right to the heart of what Buffett cares about most. So what is that 13.31%? It's the free cash flow yield. Forget all the complicated accounting stuff for a second. This is simply the amount of cold, hard cash an owner could pull out of the business each year relative to its price. It's the real, tangible return. And this is exactly why you'd call it a Buffett dream metric. For an investor like him, a stable, essential business that's gushing out a 13% cash yield every year, well, that is an absolute dream. It's the perfect cash machine. So, seems like a slam dunk, right? We've got a cheap, cash-gushing toll bridge business. What's not to love? Well, let's head over to the company's financials, because this is where our detective story takes a very, very sharp turn. And here is the puzzle. On one side, you've got this incredible return on equity, over 100%, just astronomical. But on the other side, you have a negative debt-to-equity ratio. For most investors, a number like that isn't just a red flag. It's a blaring five-alarm fire. This is the core mystery we now have to solve. I mean, what is actually going on inside this business? How can these two numbers even exist in the same company? Is this a sign of some kind of financial genius, or is it a sign of impending disaster? So here's the crucial point, the big reveal. That scary-looking number, it's not a sign of weakness at all. It's not a bug. It's actually the result of a very deliberate long-term strategy. It's a feature. So how on earth did they do it? Well, for the better part of a decade, DaVita has followed a really simple formula. Step 1, generate tons and tons of cash. Step 2, borrow more money cheaply. And step 3, use all of that money to aggressively buy back its own stock. When you do that for long enough, the shareholder equity on your balance sheet eventually just shrinks away into negative territory. And this chart right here, this shows you the incredible result of that strategy. While the business itself, the total revenue, grows at a slow, steady, kind of boring 3.4%, the earnings for each remaining share have been absolutely supercharged, growing at 17% a year. The pie itself is growing slowly, but each owner's slice of that pie is getting bigger, much, much faster. This creates what Buffett's famous partner, Charlie Munger, would call a cannibal stock. The company is literally devouring its own share count, making the shares that are left much, much more valuable over time. It's a really powerful way to create shareholder value, but it's often misunderstood. Okay, but what about all that debt? I mean, isn't that still a huge risk? This is the crucial distinction to make. DaVita's balance sheet is levered. It's not distressed. Distressed means you can't pay your bills. But with over $1.3 billion in free cash flow, DaVita has a massive cushion to easily handle the interest on its $10 billion in debt. They're using debt strategically. They're not drowning in it. So now that we've solved the mystery of the balance sheet, it is time for the final judgment. Let's grade this company on a final Buffett scorecard and see exactly where it lands. As you can see, DaVita scores really, really well on the things Buffett loves. It's an understandable business, it has a strong moat, fantastic management, and it's trading at a cheap price. But that balance sheet, even though we understand it now, it still gets a C. It is just not the fortress-style balance sheet that he insists on for his own company, Berkshire Hathaway. And so, for two key reasons, Buffett would most likely not buy this for Berkshire's main portfolio. First, at just under a $10 billion market cap, it's a minnow for a whale like Berkshire. It's just too small to move the needle. And second, that debt-fueled model goes directly against his core philosophy of owning businesses with fortress-like balance sheets. However, and this is the final twist in the story, that doesn't mean it's a bad investment. In fact, one of Buffett's top portfolio managers, a guy named Ted Weschler, actually owns DaVita in his personal account. And that, right there, is a huge vote of confidence from inside the Berkshire ecosystem. This all brings us back to one of Buffett's most famous rules, which is really the ultimate test for any potential investment you're looking at. And that leaves us with this final question. You've got a powerful, cash-gushing business with a durable moat, all at a cheap price tag. It's a company Buffett himself would likely pass on for his giant firm, but one his top lieutenant personally owns. The real question for you to consider is, could DaVita be that rare beast every investor is hunting for? A wonderful company at a wonderful price.